People are celebrating all-time highs and acting like the story is already over. That's the first mistake. When a market reaches a new high and refuses to collapse, that's not euphoria. That's pressure building. Silver sitting near record levels isn't proof the move is finished. It's proof the system is struggling to contain it. The real question isn't whether silver is expensive at these prices. The question is why it stayed cheap for so long while everything else inflated. This moment matters more than people realize. Not because silver is up, but because confidence in the pricing mechanism is cracking. Paper markets are still setting the quote, but physical behavior is no longer following the script. Tightness is showing up where it shouldn't. Premiums don't behave this way in a completed rally. Neither does persistent demand during supposed consolidation. That disconnect is where this story actually begins. At the same time, there's a narrative being pushed that this is just another cyclical spike, something like 2011 or 1980, and that once the excitement fades, silver will drift back into irrelevance. That assumption ignores what has changed. Industrial demand is structurally higher. Inventory buffers are thinner. Governments are more indebted. Monetary credibility is weaker. Those are not emotional arguments. They are mechanical realities. Markets eventually price mechanics, not narratives. You're also being told that if silver were truly important, it would already be priced much higher, as if markets are always honest in real time. That's convenient, but historically false. Silver has always been the metal that tells the truth last, not first. It exposes distortions only after they've become impossible to hide. When it finally moves, it doesn't do so politely. This is why the claim that the rally hasn't even begun needs to be treated carefully. Not as a price fantasy, but as a structural argument. If silver were merely a speculative trade, this conversation would end here. But it isn't. It sits at the intersection of monetary stress and industrial necessity. That dual role is exactly why it's uncomfortable for the system, and why it has been suppressed, dismissed, and ridiculed for decades. There's also a deeper personal element to this moment that can't be ignored. Knowledge transfer matters. Stories matter. Ideas compound the same way capital does. When information that was once fringe starts reaching people who have never questioned money before, that's when real change begins. Not through price charts, but through understanding. That's why books, conversations, and physical objects still matter in a digital world. They make ideas tangible. But let's be clear about something uncomfortable. Buying silver, or reading about it, is not an act of rebellion by itself. It does nothing unless you understand why you're doing it and what risks you're actually taking. Silver is volatile. It is politically inconvenient. It does not reward impatience. Anyone pretending otherwise is selling you comfort, not truth. And here's the tension that defines this entire discussion. If silver really is insignificant, then the effort to control it makes no sense. If it's truly obsolete, there would be no need for leverage, no need for paper dilution, no need for narrative management. Markets ignore what doesn't matter. They manage what does. This is Act 1 of something much larger. Not a victory lap, not a climax, but the setup. The part where the audience is supposed to decide whether they're watching another recycled hype cycle or the early stages of a structural break. Most people will wait for certainty. By the time certainty arrives, the opportunity and the lesson will already be gone. Here's the uncomfortable part most people skip. Silver didn't just underperform by accident. It was engineered to underperform because it sits in the wrong place in the system. Gold can be tolerated as a reserve asset because it's already captured, centralized, and largely controlled by institutions. Silver is different. It leaks into the real economy. It gets consumed. It disappears into products. And that makes it dangerous to a system that depends on abstraction, leverage, and promises instead of delivery. To understand what's happening now, you have to understand how silver has been priced for decades. The quoted price you see isn't the price of metal changing hands. It's the price of leveraged paper contracts traded by institutions that have no intention of settling in physical form. That alone doesn't make it fraudulent. Futures markets exist for a reason. But silver is an extreme case. The ratio of paper claims to real, deliverable metal is not tight. It's absurd. Hundreds of claims exist for every ounce that could realistically be delivered if demanded. That worked for a long time because almost no one demanded delivery. The system relied on complacency. As long as participants rolled contracts, settled in cash, or treated silver as a trading vehicle instead of a monetary asset, the illusion held. Price could be managed because demand was financial, not physical. But that balance is shifting, and once it shifts, paper control weakens fast. This is where people get sloppy and jump straight to collapse narratives. That's a mistake. The system doesn't break overnight. It stretches, distorts, and then quietly changes the rules. Margin hikes, cash settlement incentives, position limits, narrative pressure. We've seen all of it before. The goal isn't to make silver explode tomorrow. The goal is to slow the recognition process for as long as possible. What's different now is that industrial demand doesn't care about narratives or margin rules. Solar manufacturers don't hedge ideology. Defense systems don't accept cash instead of metal. Medical, electrical, and energy infrastructure all require actual silver, not paper equivalents. When investment demand overlaps with non-negotiable industrial demand, the buffer disappears. That's not theory, that's math. This is also where comparisons to past episodes like 1980 or 2011 start to fall apart. Those were largely financial events. This cycle is colliding with supply constraints that didn't exist at the same scale back then. Ore grades are declining. New discoveries are rare. Lead times for new mines are measured in decades, not quarters. You can't stimulus package your way into more silver production. At the same time, trust in fiat systems is eroding from multiple directions. Debt levels aren't just high, they're unserviceable without ongoing debasement. Central banks are trapped between inflation credibility and financial stability, and silver sits right in the middle of that tension. It's not someone's pet trade. It's a stress indicator. This is why the messaging around silver is so aggressive and contradictory. On one hand, it's dismissed as a barbarous relic. On the other, it's tightly regulated, heavily shorted, and structurally diluted. Those two positions cannot coexist logically. Either it doesn't matter, or it matters enough to manage. History tells you which one is true. And this brings us to the institutional angle most retail participants underestimate. Institutions don't need silver to be cheap forever. They need it to be cheap until positioning is complete. Suppression isn't about denial, it's about timing. When the flow changes from weak hands to strong hands, narratives flip fast. Now we get technical, and this is where a lot of people either lose discipline or reveal bias. Charts don't predict the future, but they do expose behavior. Right now, silver's behavior is not what you see at the end of a speculative blow-off. It's what you see when a market is digesting supply while refusing to give up ground. That distinction matters. Start with structure. Silver pushed into all-time highs and didn't collapse back into the prior range. That alone tells you sellers are no longer in full control. In past cycles, major highs were followed by violent retracements that erased months of gains in weeks. This time, pullbacks are shallow, volume is not panicked, and price is spending time near the highs instead of running away from them. That's absorption, not exhaustion. Key levels matter here, not because they're magical, but because they reflect where decisions were forced. The prior breakout zone in the mid-60s is no longer resistance. It's a line that has to fail for the bullish structure to break. As long as price holds above that region on a closing basis, the trend remains intact. Lose it decisively, and this turns into a failed breakout, which would shift risk back toward a broader consolidation rather than a straight continuation. Momentum indicators are sending a mixed but healthy signal. Relative strength is elevated, but not diverging aggressively. That suggests participation without the kind of speculative frenzy that usually marks a top. Open interest behavior is more important here than any oscillator. If price rises, while open interest stabilizes or declines, it means shorts are being forced out. If price rises, with expanding open interest, it means new leverage is entering. Those are two very different futures. Right now, the market is transitioning between the two, which is why volatility hasn't exploded yet. This is where people start throwing around triple-digit numbers, and that's where discipline usually dies. Could silver reach levels that sound absurd today? Yes. Does that mean it's guaranteed or imminent? No. The path matters more than the destination. A sustainable move requires time, consolidation, and failed attempts to break it. Straight-line rallies feel good, but end badly. Grinding advances are what transfer ownership. There's also downside risk that needs to be acknowledged. If global liquidity tightens abruptly, silver will not be spared. It will sell off with everything else in the short term. That doesn't invalidate the thesis. It tests conviction. The difference between a reset and a reversal is whether higher lows hold over time. That's what long-term holders should be watching, not day-to-day noise. For traders, this environment rewards patience more than aggression. Chasing strength near highs without confirmation is how accounts get damaged. Waiting for pullbacks into prior support or for clean continuation signals with volume is how risk stays defined. For long-term holders, volatility is not the enemy. Loss of structure is. The most important technical signal isn't on the silver chart alone. It's in the ratio between silver and gold. When silver begins to outperform gold consistently, it signals a shift from fear-driven hedging to scarcity-driven demand. That ratio has started to move, but it hasn't fully broken yet. When it does, the tone of this market will change fast. Zooming out is where most silver narratives fall apart, because this metal punishes short-time horizons. If you look at silver through a quarterly or yearly lens instead of a daily one, the question stops being how high can it go and becomes what role does it actually play in a portfolio and in the system? That's a harder question, and it doesn't produce clean sound bites. Historically, silver has never led the cycle. It lags, frustrates, and then accelerates late. Gold moves first because it's the primary monetary hedge. Silver follows when confidence in paper assets degrades enough that people start looking beyond institutional safe havens. That sequence matters. Silver outperforming gold is not normal. It's a late cycle signal. It doesn't tell you everything is safe. It tells you the opposite. Compare silver to other assets competing for attention right now. Equities are priced for stability in a world that isn't stable. Bonds are priced for credibility in currencies that are being diluted. Real estate is illiquid, leveraged, and policy dependent. Digital assets offer portability, but no industrial floor. Silver sits awkwardly between all of them. It has volatility like a risk asset, but constraints like a hard asset. That's why it's uncomfortable and why it doesn't fit clean models. cycles also matter on the supply side. The silver market doesn't respond quickly to price signals. Even if prices stay elevated, production doesn't surge. Most silver is a byproduct of other mining operations. That means supply is driven by demand for lead, zinc, and copper, not silver itself. You can't just mine more silver because price went up. That rigidity creates delayed reactions and eventually sharp repricing events. Long term, the industrial component changes the character of this cycle. Energy transition policies, whether you agree with them or not, are silver intensive. Electrification is silver intensive. Defense and medical technologies are silver intensive. These are not discretionary uses that disappear in a downturn. They fluctuate, but they don't vanish. When monetary demand overlaps with non-optional industrial demand, something has to give. And historically, it's price. This is also where the idea that silver has replaced gold needs to be handled carefully. Silver is not replacing gold as a reserve asset. Central banks aren't hoarding silver bars. That's not the argument. The argument is that silver is becoming the more sensitive truth teller. It reacts faster to stress in production, policy, and credibility. Gold reflects fear. Silver reflects strain. Timeframes matter here. This is not a trade measured in weeks. It's a process measured in years. Anyone expecting instant gratification will either over-leverage or exit early. The market is designed to shake out impatience. That's not manipulation. That's how capital transfers from weak hands to strong ones. There will be periods where silver underperforms everything else and looks dead. That's part of the cycle. There will also be moments where it moves faster than logic feels comfortable with. Those moments don't last, but they redefine perception. By the time the public narrative catches up, the risk-reward will already be worse. So the long-term implication isn't that silver guarantees wealth. That's a fantasy. The implication is that silver exposes the cost of policy decisions over time. It doesn't protect you from volatility. It forces you to confront it. This is where everything converges. And this is also where a lot of people want reassurance instead of clarity. Silver is not a guarantee, not a shortcut, and not a moral victory. It is a signal. It reflects stress in systems that rely on confidence, leverage, and delay. When silver starts behaving differently, it's not because the metal changed. It's because the environment around it did. The strongest insight to walk away with is this. Silver doesn't need a perfect storm to justify attention anymore. The baseline has shifted. Persistent deficits, rigid supply, and unavoidable industrial demand mean the old playbook of suppressing price through paper alone is less effective over time. That doesn't mean price goes straight up. It means containment requires increasing effort, increasing distortion, and increasing risk of unintended consequences. At the same time, anyone framing this as a clean break from the dollar or a sudden end to fiat systems is oversimplifying reality. These systems decay slowly, unevenly, and with plenty of false recoveries along the way. Silver will be volatile inside that process. It will disappoint people who expect linear outcomes. It will reward those who understand probability, patience, and position sizing. Another uncomfortable truth is that most people talking about silver don't actually want responsibility. They want validation. They want someone to tell them they're early, right, and protected. That mindset is more dangerous than any paper market. Owning or trading silver means accepting drawdowns, uncertainty, and long periods of boredom. If you can't tolerate that, the asset isn't the problem. What matters going forward isn't whether silver hits a specific number. Fixating on price targets is lazy thinking. What matters is whether physical tightness persists, whether industrial demand continues to collide with investment demand, and whether confidence in paper settlement keeps eroding at the margins. Those are slow-moving forces, but they compound. There is also a broader lesson here that goes beyond metals. Systems built on leverage always underestimate the importance of things that can't be created on demand. Silver happens to be one of those things. You can't print it. You can't code it. You can't settle it away with promises forever. Eventually, reality intrudes. That doesn't mean chaos tomorrow. It means adjustment over time. For traders, the takeaway is discipline. Respect the trend, respect the levels, and respect liquidity conditions. Don't confuse conviction with overexposure. For long-term holders, the takeaway is intent. Know why you hold it, what role it plays, and what would make you change your mind. Blind faith is not a strategy. And finally, this needs to be said plainly. None of this is a call to action. It's not advice, and it's not a recommendation to buy, sell, or hold anything. Markets don't care about beliefs, and neither should you. Do your own research. Verify claims. Understand your risk tolerance, your time horizon, and your financial situation before making any decisions. This discussion is for educational and informational purposes only and should not be interpreted as financial advice. Silver doesn't promise freedom, and it doesn't guarantee outcomes. What it does offer is exposure to truth under pressure. Whether that's useful to you depends entirely on how well you understand it, and how honestly you're willing to engage with reality when the narrative gets uncomfortable.